I am stunned. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, we're seeing disturbing signs of further economic weakness as claims are now reaching an unsettling level. And Fed Chair Powell and his other central bankers buddies say they won't back down. Plus, we have a sponsor for today's show. You may remember Shapeways, the 3D printing company that originally sponsored the show back in May, and since then, their stock has taken off. Well, they're back now with an update on the reverse stock split, and we'll show you why we think their stock is about to make another big move higher. Stay tuned to the end of the show or check out the description or pinned comment for more information. Now let's go to Bloomberg, where he picked today's story up with a headline: Powell defies critics and makes case for why rates must rise. Now this is a big problem here because Powell is out there trying to get everyone to believe that they are the solution to all the inflation problem. Now notably, they're not taking the blame for why we have all of this inflation, but just saying that, look, we need to raise rates even more. Now he's in front of Congress saying, look, if we don't keep raising rates, inflation's going to be a problem, and don't worry about it because look at the economy, look at the labor market, everything out there is really strong. We're making a case of why it's not strong at all. Seeking to clear up confusion about policy and play down the significance of last week's break in his 15-month credit tightening campaign, the Fed chair suggested officials were on course for 2 more rate increases this year. The process of getting inflation down to 2% has a long ways to go, he told the House Financial Services Committee during his recent hearing. And no surprise, when inflation gets to really big levels, it doesn't just magically go straight down. It is a process, but what we've been seeing in the data suggests that yes, inflation is indeed coming down. But the question many are asking is, why didn't Powell go ahead and hike at this last meeting? Why is he choosing to skip and kind of playing out that perhaps there's a couple more skips coming later this year? Well, one of those factors that we're seeing nobody really talking about, particularly behind the scenes, may be what's going on inside the banks, and we're seeing further stress on the Fed's balance sheet. So here we can take a look at the Bank Term Funding Program, and this is where banks go to the Fed. They take their illiquid Treasury securities, those things are upside down on, and they swap them for cash for up to a 12-month loan. And what we can note is this program has continued to see increased demand, and this is not what's supposed to be happening. If the banks were getting better, if we were seeing these small and mid-sized regional banks start to heal, start to recover from this early problem this year, then what we should see is their usage of this program go down as they pay those loans back. Instead, we're seeing their usage of these programs go up, suggesting there's further bank stress. And so it's possible that Powell's main reason for skipping at this last meeting was to see if some of the stress in the banking system would start to come down. Powell, for his part, focused on the central bank's so-called dot plot of forecast updated last week, which shows half of the Federal Open Market Committee expects rates to rise another half point by the end of this year. And that's a pretty good guess of what will happen if the economy performs about as expected, Powell said. Now, one thing there's to note here is these dot plots are about as worthless of anything that you could find that any government agency puts out because they have no predictive ability. They say one thing and they end up inevitably doing another one. There's such a far margin between what actually happens and what they think is going to happen. They're completely worthless. But here's what's important to know. There are 4 more meetings from the FOMC by the end of the year. If that implies that we're going to get 2 more rate hikes, as Powell is suggesting today, although it might be unlikely we see them, that means we're at least going to see 2 skips. So we could see skip, skip, and then hike, hike, or some sort of variation of that. So the fact is, even at the next meeting, if the Fed doesn't raise rates, they're still putting themselves in a position to say, look, we're just taking a little break here, but don't worry, we're getting on the gas here again pretty soon. And given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace, perhaps suggesting there'll be a hike, skip sort of setup. And much of Wednesday's hearing focused on banking regulation, but here's one of the challenges here. Republican lawmakers voiced concern that the Fed plans to tighten regulation in the wake of those failures would hurt the economy and needlessly hamstring banks. Now, I want to show you on this next slide, the banks are already hamstrung in a big way, but what will more regulation do to the banks at this point? Well, all it would do is require them to hold more cash, and lend less. And that's actually just the opposite of what the banks need to do right now. They need to lend more so they can get higher interest rates, so they can pay those higher interest rates to the cash to their customers to attract more deposits. If they were forced to hold more cash and lend less, well, it would lead to even further tightening of lending standards, which, thanks to the Fed, have already been jacked up in a big way. Here we can see the net percentage of domestic banks tightening standards for commercial industrial loans to all firms of all sizes. That is in blue. Anytime you see the blue above that horizontal black line, on net banks are tightening either at a faster pace or at a slower pace. And we've got the yield curve here, and we can note that every time the curve inverts, when short-term interest rates, when 2-year rates get higher than 10-year, and this is critical because banks borrow at the front end of the curve and lend at the long end of the curve. When you start to get near a point of inversion, you see lending standards tighten. That means banks don't want to lend as much because they don't make money lending at a loss. And so here we can see up right here, as the curve was heading into inversion, the banks on net started tightening lending standards. So this is already going to be a big throttling to the economy. I know Republican lawmakers say, look, any further regulation is going to hurt the economy. Look, any further tightening of these lending conditions is going to have a much more detrimental effect. By the time they get around to passing any new regulation, the damage will already be done. The Fed chair said he saw no sign that the turmoil in the financial industry earlier this year was leading to a severe pullback in bank lending, which is odd because I literally just showed you a chart from the Senior Loan Officer Opinion Survey that this is done quarterly by, you guessed it, the Federal Reserve. So he's not seeing anything like a credit crunch, although we're seeing that. And he thought he had added it may be too soon for that to show up. Well, perhaps it's because it is coming much sooner than the Fed chief has to believe. And we can also note that the Fed has also caused other problems here. And we can look at that from the standpoint of the overnight reverse repo. Now, you may remember this is a program where the large commercial banks were complaining to the Fed that says, hey, look, we have too much cash from all this pandemic money. Because of these international banking regulations, we get penalized for having all these customer deposits. We don't want them. So the Fed says, no problem. We'll raise what's called the overnight reverse repo rate and tie that to the federal funds rate. And we will start with that which backs money markets. So tell all of your customers to move into money markets and it gets off your balance sheet. Well, of course, we know the rest of the story was a lot of customers at small and mid-sized banks said, wait a minute, that's paying a whole lot more. I think I'll go over there. And that actually hurt the banks, those small and mid-sized banks, in a big way. So here we can look at the net percentage of banks tightening lending standards for commercial industrial loans for banks of all sizes. And now we're going to overlay the overnight reverse purchase agreements, which in the past really aren't a big deal. We saw them pop up here in late 2014. We saw them get usage kind of in 2016, 2017. But look at this. It shot up right at the same time the banks started this move higher in tightening lending standards. And sure enough, this is causing a factor as well because the banks are in such a dire need for cash. So they have two strikes against them. They need cash desperately. They can't get it because the Fed's competing with them, and the Fed's got the curve inverted because it keeps jacking up short-term interest rates, and the market keeps responding to it, putting these signs that not only will we see a globally synchronized recession, but it's highly likely, maybe not just in the U.S. alone, that we are going to see another banking crisis. I'll make the case that later on the show why we actually might see that in a lot of other countries at the same exact time. Powell, though, refused to label last week's decision a pause, calling it a skip. Instead, played up the strength of the jobs market. Well, that may not be lasting as strong as he thinks for much longer. He said the Fed was overachieving on its goal of maximum employment, with demand for workers far outstripping supply, or at least according to one of their surveys, which is not one of the most accurate ones around. With the jobs market so strong, the Fed can afford to concentrate its efforts on bringing down inflation that's way too high. While some relief on the price front is set to come from a big drop in rents later this year and into 2024, reducing inflation is likely to require some softening of labor market conditions. Now, let me translate what softening of labor market conditions really means. It means people are going to lose their job. Now, I know what Powell thinks is it means there's going to be fewer job openings. It's going to be a little more competitive, so people aren't going to be able to enter the job market market that quickly. What I'm going to suggest to you, it means nothing like that at all, because when we look at the data we just got today, what we're not just seeing is softening of the labor market, we're seeing the beginning of a large move higher in initial claims. U.S. jobless claims hold at the highest level since October 2021. U.S. unemployment benefit applications were unchanged last week at the highest level since October 2021, suggesting the labor market is cooling somewhat, which is a nice way of saying it's starting to get worse. Initial claims held at 264,000 in the week ending June 17 after a slight upward revision to the previous week's figure. This was above the median forecast and looking like it's going to get worse. Now, continuing claims, which include those who have received unemployment benefits for more than a week, fell to 1.76 million. So this is a good sign. This was hovering close to 1.8 million. So what we're suggesting, and we're going to show you in a slide, is that people are on unemployment. Some of them are finding jobs. They're getting back into the workforce, and this is a good sign. But the question is it just transitory? Are we just seeing some workers get back in jobs, but there's going to be too many other people losing jobs? That's what I think is going to happen. The upward trend in claims follows a recent layoff announcements in tech and banking, as well as signs of a slowdown in demand for temporary workers. Never a good sign. When temporary worker demand goes down, that means initial claims are headed higher. The 4-week moving average, which we've been watching closely, which can offset volatility, rose to 255,750, which notably many of you may recall I've been making the claim that once we get over that 4-week moving average, once it gets above 250,000 claims, watch out, the thing's going to shoot higher. Let's take a look at these next couple charts. Here we have initial claims in blue and continued claims in red. And what everyone's excited about is while initial claims are rising, continued claims are slightly rolling over. Now, does this happen? Yes, you see it kind of every once in a while in an uptrend where we're heading into recession. This could be just the effects of heading into the summer months. We note that restaurants have been hiring. Perhaps they're looking to hire even more, even though we talked about yesterday, there is a noticeable slowdown. People still don't believe the economy can slow down during the summer, so perhaps there's still hiring going on there. The only question is, for how long? Because here we can note that the 4-week moving average of initial claims now has broken my mythical line at 250,000. If this is correct of what we've seen in the past, that this move suggests that we're going to see a continued increase in these claims, and which means, of course, that Powell's claim that the labor market is strong, well, that would be just another central bank myth on their way to the very first rate cut. But there's some evidence that, of course, the labor market nowhere near as strong as Powell thinks. Lots of hiring, but not so much working. This from the Wall Street Journal, as companies resist layoffs even as economic weakness looms. The average number of hours worked in a week by private sector employees declined to 34.3 in May, below the 2019 average and down from a peak of 35 hours in January 2021. This could be ominous, with growth now slowing and by one measure negative. Some employers might be responding by cutting hours, perhaps in preparation for a recession. In the past, reducing working hours has been a reliable harbinger of wave of layoffs, because here's where you do first. You cut hours, then you start cutting employees. So what we're going to see on this next chart is they're cutting hours, and it tells us when we overlay the 4-week moving average of initial claims, that shown in blue, against average weekly hours, we see as average weekly hours declines, unemployment claims go up. You see that there's not a ton of data, but here you can see it, average weekly hours declining. If this continues to see any further weakness, you watch, these claims numbers are headed a whole lot higher, because at that point employers are saying, look, I have so little hours for them to work, I might as well get rid of them and give some hours to the employees I really want to keep. But it's not just Powell who's looking at raising rates and thinking they've got to do more, because the damage that he's doing is also being followed through by a lot of other central banks. The Bank of England stepped up inflation fight with surprise rate hike to 5%. And look at this. The economy is doing better than expected, but inflation is still too high, and we've got to deal with it. We know this is hard. Many people with mortgages or loans will be understandably worried about what this means for them, but too bad. If we don't raise rates now, it could get worse later, because we all believe inflation will just pop out of nowhere. What I want you to see with this headline from the Bank of England and the next couple ones is that everybody's inverting their yield curve curve, and that means a massive recession, a massive banking crisis. It could all be global. Now we see Norway raises rates by half a point to ramp up inflation fight, and not to be left out, the Swiss National Bank dials down rate hiking, meaning they hike but not as much, says more increases are likely. And all this translates to is massive curve inversions across all of these different yield curves. And here we can see, looking at just the U.S. alone, since we're focused on Powell's claim of the strong labor market, let's take a look at the yield curve in red. Now, the inversion is anywhere below that horizontal green line. I've drawn a crudely drawn yellow line with my mouse that you can see corresponds with approximately the same point at the average 4-week average of initial claims. And what do you know? When the curve starts to invert, claims start to rise. Curve inversion, claims rise. Curve inversion, rise. Inversion, soon later to rise. Inversion and rising. Why is that? Because when you see a curve inversion, what it means is banks are creating less money because they're lending less. Less money in the economy means there's less, of course, discretionary spending, and more people lose their jobs, and the whole thing starts to domino backwards. It all comes down to the fact that the curves are massively inverted here. It's not just the U.S., it's all over the world, and these central bankers are so fixated on inflation, they can't see how fast they're going to be back to zero. You're going to watch all these global central banks back to zero as fast as you can imagine. But one thing that is headed higher, at least in our opinion, is the stock for our friends over at Shapeways. They just announced a 1-for-8 reverse stock split. Now, we mentioned this on their show when they were sponsored us back in May, but now it's happening as of tomorrow. They've approved a 1-for-8 reverse stock split of its common stock. They'll be effective at 4:01 p.m. Eastern today. That's on June 22nd. The reverse stock split was approved by its stockholders at their annual meeting held on June 15th of this year. And one of their goals is to keep their stock above the minimum of $1 average closing price for continued listing on the New York Stock Exchange. In the effective time, every 8 issued and outstanding shares of the company's common stock will be converted automatically into 1 new shares. No fractional shares will be issued. The reverse split will not reduce the number of authorized shares of the company's common stock in any way. Now let's make the case of why we think Shapeways, symbol SHPW. I want to make the case, they've been great. We had them on the show. Their stock has done well. We think it's going to go even higher. I want to make that case for you because I think this is a great setup. Here, let's turn on all of our technical indicators. We first featured them back down here. The stock just took off, weighing very, very generous returns. And now, within any rally, there's always going to be a pullback. We saw a small one here. We're seeing a bigger one here. We notice that momentum is slowing, perhaps looking to bottom out here pretty soon. But one thing you can kind of easily look and see when a stock crosses a major moving average, and here's the 50-day in green, well, oftentimes it'll rally up off of it, and then it'll pull back and look for confirmation on that moving average. You see it's almost right there now, and if that happens, well, next thing you know, you get a big springing higher and moves past the prior high, and we'd be looking at this thing getting up to perhaps in somewhere in the mid 70 cents per share. Of course, that will be split adjusted as of tomorrow, but we think there's a huge return available here, perhaps 25, 50%, or even more on this next move higher. What we can note is there's been a ton of buying support back down here at 32 cents a share. We can see that with our volume profile line turned on, and this move here down is being met by a slower and slower volume, telling us the sellers are getting fatigued. And as we zoom in, no surprise, we look at this on the 30-day chart. We see people selling up here around this 52 cents level, kind of cashing in some gains, looking in to take advantage of the next pullback. But I want to look back here a little bit in time. You can see the last time they crossed a 50-day moving average, they had a bit of a pullback along the way, but the stock did very, very well there. We think the setup this time for Shapeways is even better than last time. Again, they're on the New York Stock Exchange, traded under symbol SHPW. And with that, I'm Steve Van Metre. Just remember, as with always, with any company sponsoring our show, you're under no obligation to buy their stock. Do your own research before placing any trades. And with that, thanks for watching. Thanks for being fans. Bye now.